Welcome back to Talk Tickers. This is the show where we strip away all the noise, we ignore the glossy press releases, and we get straight to the P&L.
And today, we are looking at a big one.
A really big one. A true bellwether for the entire freight economy. We are talking about Knight-Swift Transportation, ticker symbol KNX.
The big orange trucks and, well, the big blue ones, too.
Exactly. The giants of the highway. Their Q4 2025 print just hit the tape. And honestly, if you're an investor who just glanced at the headlines this morning, it looks a little rough out there.
It does. The stock's down about 4.3% in the aftermarket.
Yeah.
It's trading in that mid $55 range.
And looking at the volume, this wasn't just a casual sell-off.
No, not at all. People were definitely voting with their feet. It was a rush to the exit.
So our mission for this deep dive is pretty clear. We need to unpack this. You have a company that is, it seems, doing everything right internally. We're talking massive cost cuts, efficiency drives, but the stock is dropping.
Right. It's a classic case of better internal structure, worse external tape.
So is this just a bad quarter, or is the actual investment thesis broken? And why on earth management suddenly talking so much about driver's licenses and regulatory cliffs?
That regulatory piece.
Huh.
That's the sleeper story of the year. I really think so. Everyone is staring at the earnings miss, which, we'll get to.
Of course.
But the real alpha, the real money-making insight, might just be in what they said about the Department of Transportation.
Okay, we will definitely get to that supply shock theory because it sounds fascinating. But first, we have to eat our vegetables. Let's look at the results.
And yeah, the numbers were not great. They missed the mark.
Let's break it down. Adjusted EPS came in at 31 cents.
And the consensus was looking for 36 cents.
So that's a 14% miss on the bottom line. That stings.
It does. And the top line, the revenue, wasn't much better. It landed at $1.856 billion.
When the street was hoping for $1.90 billion, so a miss on sales, a miss on profit, it's down slightly year over year, but still.
Yeah, about 0.4%.
Now, I saw something flash across the terminal that looked even worse, the GAAP number. It showed an actual loss, a loss of 4 cents per share.
Right.
I think a lot of retail investors saw that red number and just panicked. Wait, Knight-Swift is losing money.
And we need to clear that up immediately because that's what we call noise.
Yeah.
That GAAP loss was driven almost entirely by a $52.9 million non-cash impairment.
Okay, let's unpack that. What does impairment mean here?
It's an accounting write-down, basically. They decided to fold a brand they own, Abilene Motor Express, into their main Swift network.
Okay.
So because they're killing the brand name, they had to write down the value of the intangible assets. It's a paper loss. It is not cash leaving the building.
So if you strip that out, they were profitable.
Exactly. It's not as profitable as Wall Street wanted them to be.
Got it. So they aren't burning cash. But let's look at the actual efficiency. Adjusted operating income was $101 million, down about 5%. And the operating ratio, the OR, sat at 94%.
Which is the key metric in trucking, the number everyone watches.
Right. For anyone new to the space, the operating ratio is basically the inverse of your margin. It's your expenses divided by your revenue. So a 94 OR means for every dollar they bring in, it costs them 94 cents to run the truck.
You want that number to be as low as possible in the 80s if you're a superstar.
So a 94 in this environment, it's not terrible, but
it deteriorated. It got worse by 30 basis points compared to last year. And it shows that even with all their cost cutting, the lack of freight is just hurting their leverage.
And that brings us to the big question, where did the freight go? I mean, Q4 is usually the golden quarter. You've got Black Friday, Christmas.
It's supposed to be go time for retail.
So what happened?
Well, the CEO was incredibly candid about this. He said the typical seasonal lift it didn't happen in October and November. It was a ghost.
So the retailers just didn't restock?
Not really. They had some special project activity, pop-up fleets for big retailers.
Yeah.
But it wound down incredibly fast in early November.
So they were just selling what they already had in the back, destocking.
That's what it looks like. It seems consumers were buying, but retailers were fulfilling from existing inventory instead of rushing new goods into the system.
So the holiday rush was basically a holiday blip.
Precisely. Things did tighten up in late December, right at the end of the year. But by then, the quarter was baked. It was just too little, too late.
So faced with that weak demand, Knight-Swift is doing what they do best.
Yeah.
They're consolidating. And that brings us back to the death of Abilene.
Right.
Why kill the brand now? They bought them back in 2018.
It's a move toward density. Abilene was a smaller brand, maybe 300 trucks left. In the trucking world, that is a really tough size.
A tweener size.
Exactly. Too big to be a niche player, too small to have real pricing power. And in a loose market like this, a subscale brand just gets squeezed.
So the logic is just paint the trucks white, put a Swift logo on the door, and plug those drivers into the huge Swift network.
Yes. You reduce overhead instantly. And more importantly, those drivers now have access to a massive freight network. A Swift driver rarely sits empty. An Abilene driver might get stuck in a dead zone. It's a ruthless efficiency move.
And they're not just doing this on the truckload side. They're doing something similar with LTL less than truckload.
This is arguably a bigger deal strategically.
LTL revenue was actually a bright spot, up 7%. But they announced this unified brand strategy. Why does that matter so much?
Okay, so Knight-Swift built their LTL business by buying regional carriers. AAA Cooper in the Southeast, Midwest Motor Express. Historically, they let them operate kind of independently.
So if I'm shipping something from Atlanta to Seattle, what happens? It starts on a AAA Cooper truck and then...
That's the problem. It gets interlined. That's the industry term. The AAA Cooper truck takes it to a hub in Chicago, then hands it off to a partner to get it to Seattle.
Your customers hate that.
They despise it. Every time you move freight between networks, you introduce risk. Risk of damage, delay, data loss.
You lose visibility.
You lose total visibility. The big national shippers, your Walmarts, your Home Depots, they want one throat to choke, one system from pickup to delivery.
So this is their bid to win those massive national contracts.
Exactly. They're tired of playing regionally. They want the whole map.
So they are cleaning house internally to get ready for the next cycle. And the cost discipline is actually astonishing. Cost per mile in the truckload segment was held flat year over year.
Which is incredibly hard to do with inflation. I mean, think about tires, parts, insurance. For them to hold that flat means their efficiency work is actually outpacing inflation.
And speaking of efficiency, we have to talk about the problem child, U.S. Express.
A fixer-upper of the century. It was a real mess when they bought it.
But looking at this report, the problem child is growing up. The U.S. Express adjusted RHAR improved 430 basis points year over year.
That is a massive swing. 4.3% of margin. It's the Knight-Swift playbook. They go in, they raise rates on bad freight, they fire unprofitable customers, and they cut headcount. They're proving they can fix these massive underperforming fleets.
Okay, so operationally, they're tightening the screws, they're lean. But the part of this call that really made me sit up was the commentary on the drivers.
This is the pivot point. This is where it gets really interesting.
We're not just talking about a normal driver shortage. We are talking about a forced government-mandated removal of drivers from the road.
Correct. Management called it the regulatory cliff. This is the FMCSA and the DOT aggressively removing capacity from the market.
Let's run through the numbers they gave because they are staggering. They mentioned CDL mills. What is that?
It's a commercial driving school that cuts corners. It's fraud, essentially. They guarantee a license for a fee, but they don't actually train you properly.
And the government is shutting them down.
Aggressively. About 3,000 of these non-compliant schools have been removed. Another 4,000 are on notice.
3,000 schools, that chokes off the supply of new drivers at the source.
It does. But they're coming for existing drivers, too. They talk about English proficiency.
Okay, what's the rule here?
It's a safety reg that's been on the books for years, but was rarely enforced. You have to be able to read and speak English, to read road signs, and talk to law enforcement.
And now they're enforcing it.
Strictly. Almost 12,000 drivers have been put out of service since June for failing a roadside English check.
12,000 drivers, that's like 2 or 3 large trucking companies just vanished.
Exactly. And then you have the crackdown on non-domicile CDLs.
Explain that.
It's a license for a driver who lives in another country, usually Mexico, to drive in the U.S. The issue is fraud, and some states were issuing them too loosely.
And California is leading the charge on this.
Specifically California. There are 17,000 non-domicile CDLs expiring there in March, and the state has announced they are not renewing them.
17,000 in one state, in 1 month.
Yes. So when you add it all, it's schools closing, language enforcement, license expirations, you are seeing a forced cleanup of the gray market.
All that cheap corner-cutting capacity that drags down rates for everyone.
It's being taken off the table. The supply ceiling is physically being lowered.
So the bull case here isn't that demand will boom. It's that even if demand just ticks up a little, the supply of legal trucks is shrinking fast.
Right. And management even said that January's network balance is already running tighter than normal.
Network balance being the ratio of loads to trucks.
Yeah. It's not booming, but for January, which is usually dead, it feels tighter than it should. The supply side is already shrinking.
Which brings us to the outlook. Q1 guidance is for EPS of 28 to 32 cents.
Which is fine. It's neutral. The tone was very neutral to cautious.
They definitely avoided calling the turn.
They've been burned before. They're not going to promise a recovery until they see the whites of its eyes.
Yeah.
They seem to be banking on cost and technology this year.
And what about bid season? This is when they negotiate contracts for the year.
They called the early conversations constructive. But the interesting part is that shippers are looking to move volume away from brokers and toward asset carriers like Knight-Swift.
Why? Aren't brokers usually cheaper?
Fear. Shippers are terrified of cargo theft and fraud, which is rampant right now.
You mean like double brokering?
Exactly.
Yeah.
A bad actor takes a load from a broker, then rebrokers it to some other truck, and the cargo just disappears.
A nightmare for a logistics manager.
A total nightmare. So there's a flight to safety. They know when they hire Knight-Swift, a real Knight-Swift truck shows up.
Okay, so the verdict, stock is down on the miss, but the long-term setup cost cuts plus this massive supply removal is actually pretty interesting for patient capital.
That's the summary. You have to look past the next 3 months of choppy water.
All right, that brings us to the part of the show where we stop being polite analysts and start thinking like hedge fund sharks. It's time for This Is Not Financial Advice.
And the disclaimer, we are just two voices on a deep dive. Do not trade off this. This is for entertainment.
Exactly. Do your own research. But if I were pitching a high-risk idea based on this call, I'd call this trade the CDL cliff squeeze.
I like it. Sounds dramatic. Walk me through the setup.
The setup is everything we just talked about. 17,000 licenses expiring in March, thousands of schools shutting down. We are staring at a massive artificial labor shortage hitting in Q2 and Q3. The bottom is about to fall out of the driver pool.
Okay, so what's the trade?
It's a pair trade. You go long Knight-Swift out of the money calls for August. You need time for the squeeze to happen.
Long ANX.
Yep.
Got it. What's the other side of the pair? What are we shorting?
You go short the aggravator brokerage stocks.
Ooh, interesting. Why do the brokers get hurt?
It's a flight to legality. Think about how a broker makes money. They find cheap capacity. They love the cheap, independent, sometimes gray market truckers.
Of course. That's their margin.
Right. But what happens if that cheap, dodgy capacity gets disqualified by the DOT? If those trucks are parked?
The brokers, they still have a contract to move the box. They have to cover the load.
They have to cover the load. And suddenly, they have to pay up massively for a legal, compliant, expensive truck. Their margins just implode.
Meanwhile, Knight-Swift has its own schools and compliant drivers. They become the only game in town.
They capture all the rate increase. The spread between asset carriers and brokers widens violently. The brokers get squeezed. The asset carriers get pricing power.
That is actually wildly plausible. It's a bet that the DOT holds the line on enforcement.
It's a bet on bureaucracy actually doing its job, the riskiest bet of all I know.
But based on the numbers, it seems to be happening.
So to wrap this up, Knight-Swift missed the quarter. The stock is in the penalty box, down over 4%.
But the internal improvements are real. U.S. press is fixed, costs are flat, and the brand consolidation makes them stronger for the next cycle. They're building a fortress.
My final thought is this. Don't just watch the stock price. Watch the monthly driver termination numbers from the FMCSA.
Follow the license revocations.
That's where the alpha is hiding. If those numbers keep climbing, the supply shock isn't a theory. It's a mathematical certainty.
And when supply shocks hit this industry, they hit hard and fast.
It's going to be a very interesting year for the big orange trucks. Thanks for listening to this earnings snapshot on Talk Tickers.
We'll see you in the next deep dive.